And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's Tuesday. That means it's Two Dads on Money. Jon Penn joining me this morning. And so we've got a few things to go through. We're going to talk a little bit about structured notes this morning. Something that's been kind of, they recirculate from time to time. They kind of get some interest here and there because of promised returns. And so we'll kind of go through the good, the bad, and the ugly of structured notes this morning. Also talk a little bit about adjustable rate mortgages. Those are coming back with a vengeance right now. Everybody's expecting lower rates, so buy a house now, get an adjustable rate mortgage, and hopefully it works out for you. So we'll talk about the dangers of those as well. That's all coming up on the show this morning. A little bit about the markets yesterday. Again, markets continue kind of holding here. Big news yesterday was Palantir's earnings after the bell. Stock absolutely crushed earnings. And again, kind of as we've seen lately, really this earnings season, companies that are beating earnings are simply not being rewarded for those beats. But again, these stocks have already had massive run-ups running into these earnings. NVIDIA, Palantir, as you know, NVIDIA is a good example. It's been having a good run here, but its earnings are coming up at the end of November. So again, what we've seen is as companies doing very, very well in earnings. Meta, good example, killed it on revenues and earnings. Stock's down about 11, 12% since its earnings announcement. Palantir last night, and at least, was trading down about 7% after the bell. So again, they announced earnings, doing great. Starting to be a little bit of concerns about valuations. Palantir is a very expensive company, 85 times price to sales, 225 times price to earnings. It's a very expensive stock, but it's also growing earnings at a very rapid rate. So the bet is always this trade-off between can they grow into their valuations, or is there something else going on? Well, this comes back to the whole concern about AI. Is it going to pay off, right? We're seeing yesterday OpenAI cut another deal. They've been on a deal-making spree lately. They cut a $38 billion deal with AWS and Amazon. They've cut deals with NVIDIA and Oracle and everybody else on the planet involved in AI. It's a very small community of these companies, but they're all working together on developing this AI. The question, of course, is as they're starting to ramp up this CapEx, it's eating into free cash flow because a lot of this cash flow that is being a lot of this CapEx is being spent is being done out of free cash flow. So that's a good thing, right? They're not going into a lot of debt yet, but we're starting to see AI debt starting to increase. We're starting to see companies like Meta taking on debt for AI development. Oracle has a huge debt load sitting on its balance sheet for a lot of this build out. That's all fine. That works great as long as the payoff is there. This is going to be the one big question that is going to kind of plague this whole AI trade here over the next year or two or three, is at some point investors are going to start wanting to see a return on this investment. So it's fine that these companies are doing all this, but at some point they've got to see that payoff. And with some of these companies trading at very high valuations, that could become problematic. So again, managing risk in your portfolio is going to be very, very important. I know right now it's like, hey, buy these stocks. They're just going up leaps and bounds. Palantir's up 25-fold over the course of the last few years. So again, it's just growing massively, also in price. And that's, even though it's growing revenues strongly, the price run is far outpacing what the revenue growth is. That potentially becomes a problem at some point. So anyway, just something to consider. Again, we talk a lot about markets, and again, we've talked about last weekend in the newsletter that the outlook for the market through the end of the year remains positive. Doesn't mean we're going to have some bumps, but overall, buybacks are about to come back, $5-6 billion a day in buybacks, according to Goldman Sachs, through the end of this year. So again, that's going to be a good, heavy, steady flow of buying coming into the markets, needing to get placed by year end. About 40% of companies finish up their buybacks over the next 2 months. So again, it's a lot of buying pressure for the markets. But, can that outweigh some of the other stuff that's going on? If you take a look at systematic traders, computerized trading algorithms, CPAs, et cetera, those are all kind of in a situation where they're going to be forced to sell, particularly as we get towards the end of the year. The markets has had a huge return. What's rebalancing going to look like? Is that going to put selling pressure on the markets? Don't know the answer to that. But again, these are just, while the outlook is positive for the next 2 months, one of the concerns is simply that we've already run a lot. We've had 6 straight months of gains in the markets. Talked about this yesterday. That's a long stretch. Probably make it do 7, but 8 is really starting to push out there. So again, we're going to potentially have a correction here. And that is it starting today? I don't know, but that's what you need to know before the bell this morning, is that futures right now are pointing fairly, pretty sharply lower. Dow's down about 344 points this morning. NASDAQ's down about 300 points or so. The S&P's down over a percentage point this morning. So we're going to see a pullback back to these support levels. Again, this hasn't been uncommon as of late. We've seen a little bit more volatility pick up here recently in the markets. Even though markets recently made a push to new highs, we're going to come back down, or we're going to start to try to retest some of these support levels at the 50 and the 20-day moving average. So again, kind of this the first bit of sell-off this morning is going to be flirting with this 20-day moving average, and again, below that's going to be the 50-day moving average. So again, that's about a 2% decline. We could do that today. We've seen that. We just saw that a few Fridays ago. So again, we're going to see some volatility pick up this morning. Question is this the beginning of something bigger? Don't know that yet, but it's certainly something worth paying attention to. We're still on a momentum buy signal, but that signal is at a very, very high level. So if we start getting a momentum contraction, we could see the market slip into a bit bigger correction between now and the end of the year. Again, the seasonals tend to support a stronger market, but it doesn't mean you can't have some volatility along the way. So at least worth paying attention to. And as we've noted here for a while, the one kind of big concern that kind of remains on this overall market is breadth. Breadth of the market has been just terrible as of late. And we're starting to see more and more evidence of that breadth deteriorating across sectors. And, as we've talked about before, we've had this negative divergence of, a rising stock market and deteriorating relative strength. We're also seeing that in the breadth indicators as well. So again, as you're starting to see this market go up, you're seeing this deterioration in the underlying activity of the markets. Now again, that's not necessarily the end of the world. This can happen, and you can have a bit of a pullback, a consolidation, resolve these issues, then markets are fine. But a lot of times when you see these negative divergences like this set up, it tends to precede a bit stronger correction in the market. So at least worth paying attention to within the risk of your portfolios. Some of the other areas, kind of also just in the markets, Bitcoin this morning, again, good example of kind of this risk-off trade at the moment, kind of risk-on, risk-off. There's been a very high correlation between the NASDAQ, as an example, and Bitcoin. Bitcoin's breaking down below these support levels. And of course, I don't need that right now. Go away. Try this again. We've got these support levels that Bitcoin's now starting to break below, and you're triggering a sell signal. But that sell signal, again, unlike the market, which is at a very high level, the sell signal is now at a very low level. So again, we may be getting closer to at least a short-term bottom in crypto, but you're starting to see this kind of breakdown. This is what I'm talking about. We're seeing kind of across the market, is we're seeing kind of this risk-off positioning in the market starting to occur, and we're starting to see this kind of across asset classes. We talked about this before, is that when all asset classes are highly correlated, you start getting to this problem of those highly correlated assets not only going up together, they also going down together. This is gold prices as of late, and again, this has been one of those trades with this very sharp run up in gold. Gold's now broken below the 20-day moving average. Again, struggling with 4,000. It's been really kind of trying to flirt with 4,000, trying to hold on at 4,000 level. Back below that a little bit this morning, still on a pretty big sell signal here. That was really elevated, so even though this sell signal has reversed a bit, it's still very elevated. So there's potentially some more downside risk here to go. Relative strength is getting fairly oversold here, so we could see a little bit of a bounce, but right now the trend is kind of like we're seeing with Bitcoin as well, stocks as well, starting to show those signs of weakness. So anyway, that's kind of what you need to know this morning. Just keep a watch on risk in your portfolio. And when we come back after the break, we'll pick up with Jon Penn. Don't go away.
Catch Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. So, John, I did it.
You did.
I did it. I did the thing.
You did the thing.
I did the thing. I told my wife no.
How'd that work out for you?
Well, she came in yesterday and she says, honey, I'm going to get a second Christmas tree for the living room, right? And I said, absolutely not. We are not getting another Christmas tree. You know, I just took you, no, we had a date night earlier this week, right? Took her out to eat Mexican food.
Okay.
And then took her to Hobby Lobby to let her shop for Christmas decorations. I said, dude, and I'm telling you what, if you want a date that pays off, that's the date. That's
Hobby
the
Lobby?
Date. Take your wife out for Mexican food,
all right.
a margarita, and then go to Hobby Lobby.
Margarita first.
And then go to Hobby Lobby. I'm telling you, guaranteed winner. But, so I told her no, absolutely not. So anyway, I now have 2 Christmas trees in my house. And just let you know how this works out.
Yeah, it sounds like that worked out really well. I thought you already had like 20 trees, though.
Well, that was in the old house.
Oh, okay.
So we whittled them down.
I seem to remember that being a larger number than 2.
It wasn't 20. It was 4 at one point.
It was
so
Roberts Forest.
Yeah, exactly. So I have my own Christmas tree, kind of lot for
Sell it to your neighbors. Come on in.
So anyway, it has slowed down, so it's all good. She's good, but she's very excited. My son's flying home from Germany next week. So
awesome.
I'm sorry, not from Germany, from the UK. So he's flying home from the UK next week, and so she's decorating the house, getting ready. So it's all good. It's all good stuff.
Awesome.
All right, we got some stuff to talk about this morning. Structured notes. This is kind of structured notes are a little bit of a kind of a hard topic for people to understand, because they come in all kinds of shapes and sizes, varieties, etc., and they sound really good on the surface. A lot of these structured notes are maybe a stock-specific one, right? So it's a structured note on Apple, as an example, and if Apple goes to such and such a price, you're going to get a 3x return on that potential return move. And if it goes down, your risk is very limited, maybe just a small decline to maybe no decline at all. So it just depends on how this structured note is created. And a lot of these sound really, really good on the surface. And it's like, oh, this is great. And it's usually set over a 3 or 5 year period, so you have to hold this note for a period of time. And so if you're betting on Apple being higher in 5 years, you could look at a structured note, and it may provide you some opportunity. Be very careful with them. There's a lot of problems. And one of these things is that you always have to remember is at the end of the day, there's somebody on the other side of this trade. We've talked about this before with private equity, that if you're going to invest in private equity, always ask yourself this one question: why am I so lucky? Why am I so lucky that you're offering me this outstanding opportunity, right? Because the only reason that people offer you opportunities, they're not really interested in your well-being. They're interested in their well-being, their well-being, right? They're in this to make money. They need your money in order for them to make a lot more money. So whenever you look at a private equity deal, as an example, private credit, private equity, whatever, always ask yourself the question, why am I so lucky? Why, and particularly from if you're just the individual, right? Like me or John sitting around your house in your pink fuzzy slippers. Why am I so lucky you're coming to me? Why aren't you taking this deal to Goldman Sachs or to Bank of America or to JP Morgan, who buy these deals all day long. Like if I want to do a massive real estate project, I can go to the bank and I can borrow hundreds of millions of dollars for the right project, right? People do this all the time. So why are you coming to me, right? Because you need my money. So why is this deal not good enough for you to go to another private equity fund or to some other private lender and borrow all the money you need, right? So these are the questions. And often what we find out is people get into these deals, private equity, et cetera, and the returns aren't as lucrative as they expected. Things happen, first of all. But in a lot of cases, the deals just aren't as good as was advertised. And so the returns are a lot lower. You've got liquidity issues, et cetera. The same thing occurs in structured notes. And this is generally, and again, why am I so lucky to get this awesome opportunity in an Apple structured note that's going to give me this outstanding rate of return if the stock price goes up? Well, first of all, remember, there's somebody on the other side of this trade that's trying to get rid of the stock, right? There's an institution that may have 1 million shares of Apple that they need to get off their books. Well, what they can do is they can use a structured note to liquidate a position over time. So again, they're trying to get out of the position and they're getting you into the position, right? Because they need your money. So these are always the things to think about, and as you kind of go forward, and we're going to get into some of just the risk of the structured notes, but these are the kind of the things to think about.
Yeah, and so the whole reason to discuss this is, there are a lot of investors right now. Actually, it could be every investor out there really at this point. Arguably markets are pricey. I think folks are looking for some ways to have participation with the market potentially. They want some upside, but they want to limit their downside. In times where maybe there's a concern where markets are a little elevated, I'll get questions around, hey John, what do you think about these structured notes? Or what do you think about just a structured note in its context as far as what it's designed to do? And to Lance's point, a structured note, it's actually a debt obligation that is where the performance of that obligation is tied to a specific. It could be a specific stock, it could be a market index, it could be a currency. So, for example, you could look at a structured note where, let's say, the term of the note maybe it has a term of 3 years. And the performance of the note is tied to the performance of the Standard & Poor's 500 index. So that structured note lasts for 3 years. That's the term. So you put your money into that. You can't. It's very illiquid, right? So just like there are some similarities between a structured note and with private equity. You put your money into a structured note. It's not like you can turn around and get your money out within 24 hours, right? This is money that you need to be able to set aside because structured notes are not liquid. So then this particular note that I brought up, let's say it's tied to the performance of the Standard & Poor's 500 index. Well, you get the return after the note finishes in 3 years. So here's where you have to be careful with the structured note. So let's say in year one, the Standard & Poor's 500 returns a positive 10% return. And let's say you're not capped or maybe you're capped to the upside of, 30%. Over those 3 years. So maybe over the 3 years, maybe the S&P goes up, who knows, 50%. You're going to be capped 30% to the upside. So you're going to get some participation to the upside, but if the market goes down, your principal is protected. You will not lose money to the downside. That is the appeal of the structured note. But here's where you need to be careful. Let's say in year one, that structured note return, let's say the S&P 500 is up 10%. That's a paper gain. You haven't realized or you haven't received the return because you're not going to get the return until after that 3 years is up. But if in year one, the Standard & Poor's 500 index is up 10%, you as the holder of the note, you will have to pay tax on that 10%. That's called phantom income. So you're going to pay phantom income tax on year one. Let's say the S&P 500 is up another 10% in year two. You're going to pay phantom income tax in year two. But let's say in year three, so year one you're up 10, year two you're up 10, but in year three, let's say the Standard & Poor's 500 index goes down 20%, so now your return is a net zero. Now the note's over. You haven't lost money. You haven't gained anything on your principal either, but you haven't lost on your investment, but you've had to pay phantom income tax on year one and year two, but you haven't really received any return from the note. So you haven't received any return on your money, but you've had to pay phantom income tax in year one and two. So you really have to understand how taxation of these work, because you're going to get taxed like you own it, even though you haven't realized any gains. It's just paper money. So sometimes with these structured notes, if you can, it might be more appropriate to place something like this in an IRA.
Yeah. And again, you really hit also too the whole liquidity issue is a big issue, because again, there's no secondary market for these structured notes.
Right.
So if I sell you the note, right, you own the note now, and you want to go sell it, you've got to go find somebody to buy it from you. There's no active secondary market. And this is what he's talking about. There's no liquidity. So in order to sell it, you generally wind up have to sell it at a fairly deep discount to try to find somebody to actually sell this thing. So now you're really kind of, you bought something that if the market goes up 10% a year, you're going to make, this money. But if the market's not going up, you're not making anything, right? And so you go, okay, well, I'm gonna get out of this. It's not working. You can't. And then you have to sell it at a loss, because you've got to basically try to find somebody at a deep enough discount. And generally, the issuer, you can get them to buy it back, but they're going to sting you for it. Right. They're going to be on the good side of that trade. You're not. So again, these are just, this is the same thing that goes with every product in the markets. First of all, there's no free lunch. Nobody's giving you anything. When somebody's offering you a structured note or a private equity deal or a private credit deal or whatever, as I said before, nobody's giving you anything. They're not out there looking for your best interest. They want your money. They're trying to figure out a product to sell you. Hey, you want a lot of speculation? Here's a 5 times levered ETF. You go buy it, that's awesome. Hopefully it goes up for you and you make some money, but what they wanted was the assets under management that they can charge a fee on, right? So everybody is out looking for your money. So just remember that question, right? Why am I so lucky? And then most importantly, ask, what are the risks of this? This sounds great on the surface, but what if something goes wrong? This is the one question that I don't think enough people, I don't experience enough people asking this one question of what could go wrong?
Yeah.
Right? What happens if, how do I wind up losing money on this deal, right? What has to happen for me to lose money? Oh, well, the market has to go down like 20% over 2 years. That's happened. And it could very well happen, right? So again, just always ask the hard questions. And particularly if somebody's trying to sell you something and you ask the hard question, they can't answer it, you should pass on that investment really quick. Because if they don't understand what the risks are, then you're probably getting into a whole lot more risk than you realize.
Yeah, so like for example, with the structured note, that example that I was rattling through, where the structured note, the performance is tied to the Standard & Poor's 500 index. Really, the risk isn't necessarily that the market goes down. These structured notes are typically issued by banks, by financial entities. So the note, the security of the note is really backed on what is the strength of that financial entity that's issued the note? What is their creditworthiness, right? So for some reason, if we get into, so your note might be tied to the Standard & Poor's 500 index, your note might be tied to NVIDIA. Knock on wood, NVIDIA's had a nice year so far this year, right? But what if that particular entity that issued the note, what if they get into financial trouble or they get into financial distress? It doesn't matter how good NVIDIA is. If that issuer goes under, guess where your note goes? It goes along with it. Yep. So those are some of the risks that you have to think about. And so I'm not saying that structured notes are bad.
No.
They can be used for the right person, for the right investor. It may fit. But you always have to look at what are the pros and cons. And Lance, to your point, I think a lot of us fail to ask, well, hey, what could really go wrong? Right.
Right, and again, and John, that's a great point.
Yeah.
I mean, again, I'm not poo-pooing any investment, right?
Sure.
As we've said before, every investment structure is a tool, and they all have benefits. They all have, deterrences to them. And so, if you just think about having a toolbox, right? I've got a lot of tools in my toolbox. I've got screwdrivers, I got hammers, I got wrenches, I got pliers, I got all these other things, and each one of those tools has a special application, right? And as long as I use that tool correctly, it'll work really, really well. It's when I try to drive a nail with a screwdriver that things tend to go wrong. And you just want to use these tools properly and for the purpose they're meant. And the problem as investors, we get so wrapped up into chasing returns. It's like, oh my gosh, this is going to offer me all this upside, and they tell me there's no downside risk. There is always downside risk. always, there is no investment ever made that doesn't have some downside risk at some point, right? It doesn't matter what it is. You can lose money in the short term, in the long term, in the medium term. You can lose money on any investment that you make other than money market cash, right? So, that's your truly only safe investment. And we've talked about this before, is that with every investment, you have three things for every investment. You can have safety, you can have liquidity, and you can have return. But you can never have all three. You can only have two of the three. If I want safety and return, money markets, right? I'll never lose money, and I'll get a little bit of money market interest, right? So I have safety and return. If I want liquidity and return, I can buy equities, but I have no safety. So again, everything you go through has only two of the three components. There is no investment that offers you all three. And so always factor in what's most important in that. So when you're looking at a structured note, an annuity, an insurance policy, a mutual fund, an ETF, a stock, ask how that fits within the risk profile of your portfolio that you're building. And again, because as we've talked about here, previously, when you put all the components together to build your portfolio, it needs to fit within your risk profile so that you can weather the volatility, because markets are going to go up and down. And as long as you can maintain the volatility of that and stay invested, you can win in the long term. What happens with most investors is they go out and they chase all these speculative assets, and then when things blow up, they blow up with the markets and they can't recover. So again, when you're building, all these things are tools within your toolbox. But when they all come together, they have to form a structure that is safe, secure, and creates return over time and provides you all three of those factors. You want your portfolio, again, no investment can give you all three, safety, liquidity, and return, but a portfolio can. If you build it correctly, a portfolio can provide safety of your capital, it can provide liquidity of your capital, and it can provide return over time. That's what a well-balanced, constructed, allocated model will do for you. But you have to be willing to understand what those risks are.
Yeah, it comes down to just, and again, I know I've said this before, but it just really comes down to understanding what you own. Just know what you own just before you invest in it. Understand how it works. Even just in the world of mutual funds, it can sound so simple, but there's thousands of mutual funds out there. There's thousands of exchange-traded funds out there. And if you're not familiar with what a mutual fund is or how it works, if somebody is recommending one to you or a portfolio of these to you, if you're not sure what these are, ask, and just so you know how these work, and what does the mutual fund or what is that exchange-traded fund, what are the internal securities that it holds. There are a number of times, Lance, where I'll visit with folks where I'll review their investment portfolio and look at their holdings, and the comments made to me is, John, I don't understand why my portfolio is so volatile. I thought I was using these safe, very broadly diversified mutual funds in my portfolio. And I'll say, well, let's take a look. And I'll ask, has anybody really taken a deep dive into these mutual funds or these exchange-traded funds to really show you what the internal holdings are? And most of the time the answer is, not really, or maybe we weren't really paying as much attention as we should have. But I look at some of these investments, and they're volatile during times of market stress. And all of these mutual funds have very speculative stocks within them, or even funds that have the word conservative in the name. It's a conservative mutual fund. There's a pretty hefty allocation of bonds in that mutual fund. There's one in particular where there was close to 30 or 33% invested into high yield bonds. Junk bonds, and those can be very equity-like during times of market stress. And it's just, get a good understanding of what you own. And if you don't understand what you own, just find somebody to ask that you trust, where you can get a lay of the land and find out if what your money is in, is it appropriate for you. But just before you put your dollar into anything, like Lance said, just make sure you understand how it works.
Yeah. And I'm just kind of watching chat. We're talking, and there's a lot of talk about options in our chat right now. And again, options are completely fine, right? Puts and calls. But just understand that those have an inordinate amount of risk, right? Yes, you can sell puts into a rising market. That works fantastic until one morning you wake up and you've sold a bunch of puts on stuff, and that stock price opens below your strike. And now you're having to buy the stock at a much lower price to cover your put. things can go wrong in the options market. The options market is not a safe investment. You know, buying calls and just selling them for appreciation, that's awesome until things go wrong. And you wake up one morning and the market's down 3-4%, which can happen. So again, these are there's no safe investment. There's nothing wrong with trading options at all. People do it all the time. And it can be very lucrative. It can also be very devastating. So just understand that, you better have a really good control of your risk profile if you're trading options, because options are binary. They either make money or they lose everything. And if you're selling stuff on options, that means that not only could you lose everything in the option, but you wind up having to buy stock and give it to somebody else at a much lower price to cover that option. So again, things can go very badly very quickly in the options market. Just understand the risk profile. There's, again, nothing wrong with it. Just understand you're taking in an elevated level of risk when you're trading options in the markets. So again, we trade options too. We have a portfolio that runs options. So again, it's fine. Just understand the risk profile you're taking.
Yeah, I think, and what is the rate of return that you're trying to achieve, and how much risk are you taking to get that? And if you're not a very aggressive investor, if your rate of return is a little bit less than what you see what the market's doing this year, well then, at the end of the day, just don't compare yourself to the market. It doesn't matter. Mm-hmm. What you really need to figure out is what is your rate of return, right? What is your benchmark? What is your hurdle rate? And I know we discussed this the last time, but figure out what your rate of return need is first, and then from there you can back into a portfolio design that incorporates all of these objectives into something that really supports your goals and objectives, right? So understand the risks that you need to take and what is your return expectation, and just don't compare yourself to the market. From an emotional standpoint, you're setting yourself up for a stressful time, in my opinion.
No, it is true. So anyway, let's change gears here a little bit. Talk about adjustable rate mortgages. We're starting to see, so adjustable rate mortgages were the worst thing ever invented in the real estate market. So, and here's why. Pre-2000, housing prices appreciated about 3% a year, give or take. It's just a little bit above the rate of inflation over time, fairly steady over time. You could buy a house and your inflation rate would go up about 3% over time, and it was fine. And then we started out in 2000. This was started with Alan Greenspan as he started pushing these adjustable rate mortgages and saying, hey, we get this adjustable rate mortgage and we need to get into lower down payments. We need to split up mortgages into, instead of having a 20% down payment to avoid mortgage insurance, you could split your mortgage into 80-20 and try to avoid the mortgage insurance. So we started doing all these things to get more people into houses. This was all pushed through government by the National Association of Realtors and the real estate markets and everybody else, all the realtors. And because they wanted to sell more houses, that's fine. Adjustable rate mortgages came along. Alan Greenspan's pushing these things going, hey, this is the greatest thing ever. We need to get adjustable rate mortgages. You can get this lower interest rate, but it's going to be fixed for a period rate. You'll get this lower rate for a period of time, but then it will adjust at some future date. So as long as interest rates go down, this was awesome. Well, the problem was you drug all these people into the market, you shot home prices exceedingly higher, right? And this has been the problem today is people go, I can't afford a house, houses are too expensive. Well, yeah, it's because ever since the turn of the century, we broke the housing market with all of these other type of funding vehicles to get people that can't afford to buy a house into houses, people that can't afford to save up a down payment into a house. Even today, you can get a Fannie Mae mortgage at 3% down. That should not be the case, right? If you can't afford to save more than a 3% down payment for the house, you probably should not be buying the house. As we've talked about before, just owning the house is great, but it can become a prison really, really quickly because all your money is being sucked into the house, the maintenance, repairs, upkeep, everything else. It's like I just had to spend $1,500 at my house to fix a broken thing, right? And that happens. And so all of a sudden it's like, if you don't have the free cash, there goes your vacation fund, right? There goes your new car fund, whatever. And you become a prisoner, you become house rich, but you're asset poor because you can't afford to do anything else. So again, this is what we've done to the markets, and this is why housing prices are so out of whack, and again, years of zero interest rates on the Fed funds rate and exceeding the low mortgage rates. We've just blown this massive bubble in housing that's going to take a long time to resolve itself, unless we start to go back to more of the fundamental basics of buying a house, right? But again, now we're starting to see, which is interesting, right? We're starting to see this readoption of adjustable rate mortgages. Mortgages got up to about 7%. And now people are betting on that mortgage rates will be lower in the future, which I find ironic because everybody that is running around the media is like, oh, interest rates are going to the moon because of the debts or the deficits, whatever. There's all these reasons. And so you're going out betting on a mortgage that your mortgage rate will go down in the future and not up.
Yeah. Don't look at, everybody's, that's such a great point because so many people that I visit with, and it's a valid concern, you're concerned about higher rates of inflation, and inflation eroding your purchasing power, and looking at interest rates on longer term bonds. But then at the same time, when we're looking at making a major purchase or looking at buying a house, it's I think interest rates are probably going to be lower in the future, so I can justify using an adjustable rate mortgage. I haven't seen. I am seeing more of the first time home buyer explore using an adjustable rate mortgage now compared to somebody that's more of a cash buyer. Right, obviously a cash buyer, they're not going to use a mortgage at all. But I'm seeing, especially in younger investors right now, looking for a first-time home or for their first starter home, I'm seeing that folks are more open to using an adjustable rate than a fixed rate.
Yeah, and look, I've used an adjustable rate mortgage before, right? I had a 7-year adjustable rate mortgage, and I paid the house off in 7 years. I mean, I just aggressively paid off the mortgage on the house. And so again, I didn't have to worry about the lockup period expiring and then that thing adjusting higher or lower. I didn't have to worry about it. So as long as you're going to use an adjustable rate mortgage for that, that's fine. But if you're but my point is more of, for younger investors that are just coming up, this is your first home, maybe you're going to move to a bigger, you've got married now and you're having a kid on the way, or you've got a kid and need to move to a bigger house. Just be real careful with the adjustable rate mortgage because you're forcing yourself into a house. You can say, look, I can afford the house based on this rate, right? So as long as I can, a standard mortgage I can't afford, I can afford the adjustable rate because they give me a lower price today with the expectation they're going to make it up on the back end somewhere else. So again, nobody's giving anything for free. Somebody's going to make money on this. But if you can't afford the house at a normal mortgage rate, you probably really can't afford the house on an adjustable rate. So you need to start thinking about your financial situation. Again, you don't want to become a prisoner in the house and it's just absorbing everything that you make, particularly, as things occur over time. But, if you say, look, the whole reason I'm buying this house is, because I'm betting on lower rates in the future, that's not really the right way to approach it. Again, you don't want to take on that risk because what happens in 7 years if interest rates are 2% higher than they are now, which could happen. I'm not saying that interest rates can't go up, right? I think interest rates will be lower in the future because of economics, demographics, a whole lot of other reasons. But what if the other outcome occurs? And you have another situation like we saw in 2022, 2023, and interest rates spike up and then your adjustable rate mortgage adjusts and now you're priced out of the house. Don't take on risk bets, particularly when it comes to your house. Don't take on that kind of a risk bet. It's not worth the outcome. To try to manipulate interest rates to gain an advantage here or there, you shouldn't do that with your primary residence.
Yeah, especially because typically real estate isn't very liquid either. So if you really get in a bind, it's very unlikely that you'll just be able to sell that house overnight. Yeah. To get yourself out of that situation, right? But I get it. I can see the appeal of using an ARM, especially if you're more of a first-time home buyer. I looked at just what the average cost of a quote-unquote starter home is just in the general Houston area, and it ranges anywhere from $300,000 up to $350,000.
I don't know where you're looking for a starter home. No, where are you looking?
That's what I said.
There are 585 houses in the Houston area that are less than $250,000.
There's 585?
Yeah.
Where are they located?
All over. They are literally all over the place. But these aren't neighborhoods like, John's over here looking at, he's looking for neighborhoods where everybody's like white picket fences. Like, that ain't your starter home. My first apartment was in the freaking ghetto, right? I mean, your starter home is not going to be in this white picket fence neighborhood with, no, but see, this is the problem that we have is that everybody's got this misrepresentation of what the home should be, right? Their first home
true.
out has
Yes.
got to be this, 3,000 square foot home in the best school district with a pool in the backyard. Yeah, that's going to run you $450,000, $500,000 for that. Yeah, you can't afford that.
I didn't say $450. I said $350.
Yeah, that's even to starter home. What are you talking about?
So anyway, so what? So you were looking at prices. What did you see?
I was having an argument with this young gentleman the other day. He's like, I can't afford to buy a house. I go, what can you afford to buy? $250. And so I went on to Har. I said, here's 585 of them, all over. I mean, they're in spring. They're all over the place, right?
So even $250, $250,000 for a starter home. I mean, that's not chump change,
No,
right?
it's
So
not.
I can see.
Well, no, there were some in the 150s, but probably wouldn't want to own that one.
Ooh.
Yeah.
They may not, those may
You
not have
can buy that house. You just better have you better own a gun. But
it may not have a roof on it.
no, it had a roof and a front door. But you better have a gun, considering what part of the
comes
the
with
neighborhood.
lead.
Exactly. So, but yeah, I mean, but no. The point is that you want to make good decisions about buying your home. And again, we get into these, we have a detachment from what we think we can afford versus what we can really afford.
Yeah.
And then when we figure out what we can really afford, we start trying to figure out how to finagle our way into it. And again, look, rental rates are falling sharply. The number of multifamily residences that are vacant is rising sharply. Again, so this is going to put downward pressure on housing prices eventually. So again, prices are going to come down in housing. So if you're patient and wait, you'll be able to buy a house at cheaper prices at some point, because just it's a function of supply and demand. But the problem is that we keep messing with the demand side. And again, if you would just leave the demand side alone, quit providing all these things to get people into houses they can't afford, the supply-demand imbalance would eventually cure itself and houses would return to a normal, sustainable rate of return. But again, we keep doing all these things government-wise, agency-wise, et cetera, to try to figure out how to get more people into houses they really can't afford. And that's what's keeping prices elevated, and particularly in an environment where people aren't selling either. You take a look at, all real estate pricing happens at the fringes. So it's just the number of people that are actually actively buying and selling a house that adjusts the prices of homes nationwide. If you're not selling your house, you're not affecting the price of the market. It's only the people that are buying and selling. And so right now, if you take a look at the number of transactions in the country, it's very low. We're selling a house a month type thing. So, what's keeping prices elevated right now is really a lack of demand versus supply, because the supply-demand imbalance is just still out of whack. But if we get rates down to where all of a sudden, baby boomers can start to, finally I can sell my house and go move to Florida or wherever I want to go for retirement, we could have a big glut of inventory come on markets that would drive prices down, et cetera. But again, those are things that can happen. So, I wouldn't be rushing in and trying to finagle buying a house that's really pushing my affordability. It's like, if everything goes right, I can afford this house. Right? It goes back to our other conversation about structured notes is, always plan for what could go wrong. Yeah. What if rates go up? What happens to me and my family? What if I lose my job for 3 months, right? Or 4 months or 5 months? What happens to my house and my family because of that? You don't want to put yourself and your family into a position that all of a sudden you're so strapped buying this house that if anything goes wrong, and life always happens, that you're basically either being forced to sell in the house or getting foreclosed on something. You just don't want to go through that.
Yeah, and so like what we were talking about with structured notes, even with adjustable rate mortgages, there's a pro and a con with everything. And you just have to really understand the cons. What could possibly not work out, or what could not go right that could affect you, right? And there are a lot of younger investors that I visit with where they are in the process of really saving up for their first time home. And it's not just the down payment, then it's everything else. It's it's the window treatments and the furniture and everything else. It's okay, well, how much have you really budgeted and how much do you have left over? Because heaven forbid, what if you do have a change in employment, or what if you lose your job?
Hey, we're not talking about big spreads here either, right? I mean, you're talking about an adjustable rate mortgage right now at 5 1/4.
Yeah.
And you can get a fixed 30-year mortgage at 5.75 to 5.8, right? just even call it 6, right? So I'm going to get an adjustable rate at 5.25 versus a 6% fixed for 30 years. You're equivalent over 75 basis points. This isn't like it was previously where there was a 2-point spread between fixed and adjustables, right? So if you can't afford that difference, I mean, if the whole choice of buying the house comes down to 5.25 versus 5.75, you can't afford to buy a house.
Agree. Just
right?
wait.
Just wait. Be patient.
Yep. Be patient. Agree.
So, any closing comments?
No. I enjoyed the banter about the home prices. That was fun. I'm going to go back and paint my white picket fence.
Well, I mean, you grew up rich. I mean,
Oh.
I grew up, I grew up poor. My first house was literally, somebody made this comment also in chat.
Yeah.
His first house was a cardboard box. I lived out of my truck for 3 years, by the way. But, my first house, the first house I ever bought, it was a shack. I mean, but I was proud to own it.
Yeah.
Right? I took care of it, painted it. There's a big fixer-upper. But, yeah, it was a shack.
Yeah, I remember the first home that we bought, and shame on me, I should have kept it. I sold it too soon. So things that you learn is just as you're coming up through your years. I should have kept it and turned it into a rental, but I didn't know at the time.
Yeah.
I should have done it.
Yeah.
But
Yeah.
Fun stuff.
All good. All right. Well, thanks for joining us today. Next week, we're going to go through a whole list of stuff that you should be teaching your younger kids, right? A couple of things we touched on today, but we'll kind of go through the whole list. It was actually an email from one of our listeners, from Nathan, and appreciate it very much. We're going to adopt that list in the whole show for next week. Go through 10, 12, 15 points of things, kind of the lessons to teach your kids about money, and particularly as they move into life. I just had this conversation with my son over the weekend, who just turned 22. It's his 22nd birthday. So
Awesome.
yeah, you're growing up fast, man. Time flies. But anyway, get by the website, realinvestmentadvice.com. Get our latest blog posts and more, of course. Like and subscribe to the channel very much. We appreciate that. And we'll see you back here tomorrow for the next edition of The Real Investment Show. Have a great day.